This week on Resource Rundown, silver breaking to 14-year highs, and a conversation on the gold and silver ratio. ETFs in the resource space, especially in lithium, that just don't make sense. And the energy sector, what the Iran conflict is doing for oil prices. Welcome to Resource Rundown, a Clear Commodity Network podcast, your weekly pulse on the resource sector. Each week we break down the biggest headlines across mining, energy, and critical minerals, along with the key price action in commodities like gold, copper, uranium, oil, and more. Hello, everyone. Welcome to Resource Rundown. Corey Fleck here, and as always, joined with my good friend Matt Battiali. Matt, let's start off with the silver sector. This is a pretty key news event in the last couple of weeks for all the silver investors out there, with silver breaking to levels that the market hasn't seen in 14 years. Silver back up, closing in on $40 an ounce, but most importantly, broke that $35 level. And now we're hearing all the silver bugs coming out saying, I told you so. Silver has a lot of catching up to do. And we're also seeing a lot of silver stocks, some of even the smallest silver stocks really running. Matt, what's your take from this silver breakout?
Yeah, the silver bugs are finally able to come back and say, I told you so. We're still off the highs that we saw in 2011, but it's been a pretty good run, under $15 an ounce to almost, like you said, almost $40 an ounce now. I think there's an industrial component to this because solar is the largest and fastest growing segment of the energy sector, which is growing right now. But you also have this distortion of the gold to silver ratio. And this is we see this when you start talking about equivalencies, when you have a mine that produces multiple metals that you sell, you usually will you'll report the grades in the dominant metal, and then you convert the secondary and tertiary metals into value in terms of that metal, the primary metal, which sometimes doesn't work that way. Like there was a time when there were lots of silver miners that were getting more value out of their lead and zinc than they were out of the silver they were producing. And so there was a time in the, mid 2010s when they were nominally silver miners, but they were really lead zinc producers in drag. But right now, the historic ratio of gold to silver, it was around $50 an ounce, or 50 ounces of silver to an ounce of gold. That's how you calculate this. So you take the price of gold and divide it by the price of silver, and you get the number of ounces that you can buy of silver for an ounce of gold. And right now we're at 93. It's been as high as 125 ounces of silver to an ounce of gold. And so we're way, way out of bounds from a historic average perspective. And so there are a lot of people who, they see the gold prices run, and the silver price hasn't matched it. And historically, like if you go back to that 2005 to 2011 period, the performance of silver really outperformed gold. I mean, if you go back, you can even go back to 2002, the price of silver was under $5 an ounce and it went to $50 an ounce. So you have some excitement here based on a combination of historic um, precedent, the run of silver prices from 2002 to 2011. You have the increased demand from an industrial side with solar power, and then you have the fact that gold prices have run and silver prices haven't matched them. So there are some tailwinds here.
Matt, the one thing that I find with silver, though, as much as it gets tied into gold and tied into the precious metals, it is viewed as a precious metal. But the whole question is what actually drives the price of silver? Because we hear the silver bug saying it's a precious metal and it's also an industrial metal. So it's kind of walking that fine line. But quite frankly, man, you look at it almost like a crypto, and it's not like this, but it's almost like the meme coin to gold, where it can spike higher, then also drop, and people are wondering what's causing these prices spikes, and they can look at all these different things, but quite frankly, I find it very interesting right now, this definition of what a precious metal is
Hmm.
and the industrial uses here, because if silver loses that whole precious metal status, then I could see the price going quite a bit lower if it decouples from gold. But quite frankly, it is still viewed as a precious metal. Although I have to say, a lot of younger people maybe don't quite view it so much as a precious metal, or the younger people don't even care about precious metals. But if we define a precious metal here, it's rarity and value. So, rarity, it doesn't seem like silver's all that rare. The value, it's 100 times less than silver.
Yeah.
Corrosive resistance. That's
No, it tarnishes
questionable
it.
as well, right?
Yeah.
And then ductile can be easily shaped. Fine, got it. The one thing that sticks out to me, historical significance. Yes, that's really what the precious metal is right here is people think that it is still a precious metal. So that's where I come in here is what is actually driving the silver price, taking into account that yes, it's a precious metal, yes, it's industrial metal, but those are two completely opposite tracks because silver's getting used in one and the other silver's just getting saved. So how do I make sense of what actually drives the silver price outside of just pure speculation?
You know, every market has a pretty significant emotional component to it. And I would argue that certainly silver's run back in that 2002 to 2011 or 12 period was FOMO, right? It was running, therefore it must be valuable. Somebody else thinks it's valuable. I better buy it. And it's the same urge that has fueled every mania from tulips to cryptos to digital ape pictures on the internet, right? So I think that's part of it. If we talk about intrinsic value, I agree with you. I'm far more partial to platinum as a precious metal, even though it's very much an industrial metal, but it just doesn't, it's stronger. It doesn't tarnish the same way that silver does. So silver, I think, is very much riding gold's coattails as it has always done. And it's still money, it's still jewelry, and it's much more approachable. Silver earrings are less expensive than gold earrings are today. Therefore, they're going to be more in demand. Therefore, there's going to be a jewelry aspect to it. And as jewelry, it's better than, copper from a corrosion point of view. Not as good as gold, but that's kind of where we are. But yeah, I think you're right. I think from a precious metals point of view, I think it's resting on its historical laurels.
Well, and to that point, the one thing that I get really caught up in is look, the central bank demand for gold has been a key driver here, right?
Yes.
And central banks don't buy silver. So there's a big disconnect there. If the status quo keeps playing out, something that we have seen over the last 4 or 5 years is central banks really getting on the gold train and buying a lot of gold. I get that as a driver for gold, but that's a big missing component for silver that we expect retail and simply investment demand to pick up for how much central banks have been buying. There's a big disconnect in my eyes there.
Yeah. No, I would agree with you. And look, from a volatility point of view, like silver silver will break your neck. It'll whipsaw you up and down in the financial crisis period from 2000, that 2008 year, silver got crushed where gold really didn't. I mean, the silver price got absolutely demolished. It fell by more than half. So it is far more volatile, and so I think that kind of supports your thesis that there's a speculative aspect to it, that it's less about the intrinsic value and more about the emotional component.
Hey, I'm not saying silver can't go much higher. We've seen it go much higher. Quite frankly,
Absolutely.
in the chart, it looks like $50 could be in play here sooner rather than later because there's not much resistance. But fact of the matter is, to me, it just seems like a little bit of shakier footing. Again, it almost driven by if meme coin investors got behind it or meme stock investors. We actually saw that back at the last silver spike. They managed to move the silver market, not
Yeah,
to the same extent of meme stocks, but
they
I just
did
find it
pretty well
interesting. It
though.
did do very well, and it can be a great trade. But what do you think of silver mining companies then? Because quite frankly, most silver is produced as a byproduct. So
Yeah.
these individual silver mining companies, mostly out of Mexico, yeah, they can make a lot of money when the price spikes, but if the price goes into another trough, these guys don't have any other mineral credits to fall back on.
Yeah. There are a couple things. If when a commodity price is moving like silver's moving, I want to buy a basket so I don't get kind of trapped in an individual company shitting the bed. So if I'm playing a commodity price, the companies almost don't matter. Just buy a handful or buy an ETF and ride it that way. If I'm looking at individual silver companies, I agree with you. I want to find if it's a silver company that tells me they're producing silver, I would much rather see them have a gold credit, like a silver vein with gold than silver vein with base metals. But what you're going to see, I mean, look, if these guys were break even or better at $15 an ounce silver. So let's say they've had a mine in production in Mexico and they were doing okay. Maybe they were just tootling along, just head above water at 15 bucks. We're now almost $40. So the valuation is going to come way up on those silver miners because they're going to be stacking cash in the bank. And so, it's a parallel to what we're seeing in gold right now. These things can be crazy profitable. If they cut their teeth on lower silver prices and you effectively double the price of what they're creating, what they're mining, they're going to be really popular or really profitable. And then what you do is you you know, a mine, any mine is finite. Like it's a loaf of bread. So if you're a sandwich company and you're making sandwiches, when your loaf of bread is gone, you don't close the business. You move to the next loaf of bread. And all these mining companies have to do that, whether it's through growing the existing mine, exploring the property, or going out and making an acquisition. So that extra cash is going to come back into the sector in positive ways. So that's why I say like owning a basket of these stocks is good because then you get the benefit of the cash that comes back in as takeovers or as revaluations on better profitability. I like those things. If you want to play silver and you want to use a microscope on a single company, man, you better be a really good analyst, a really good stock picker, and really lucky because it's difficult. It's very, very difficult to pick one stock in this sort of uptrend and get the full benefit.
Yeah, you're so right. Taking that individual company risk, especially in something like mining, but really in any sector,
Yeah.
it's why I think we have so many ETFs out there. And we'll get to this whole ETF conversation too. But look, I think within my portfolio, at least, I think I hold a few quite good silver companies, some of the best silver companies. Those have done very well. But I'm even seeing some of the crappy silver companies that I hold, and we all hold crappy companies in the sector. Even those are starting to do well. So I don't know
Well,
how to handle it, but clearly there is some interest that is coming into the silver space. And even look at the volume on SIL, the silver ETF. That volume is extremely high, if you ask me. So
yeah.
there's clearly interest here. Now, the question is just how much higher will the silver price go? But that also ties in with gold, right? Gold mining companies. You and I were talking off mic, and you're making the argument to me that these companies still aren't valued for the type of cash flow they're generating. So share with our audience why you think that, and I'll come back with you.
Yeah, it ties in really well to that point of if you have these companies are not like Apple. Like Apple goes out and they test the market and they say, we're making a new phone. Will you buy it for 1,500 bucks? And it really doesn't matter how much it costs them to make it, right? The all-in cost of an iPhone and its gizmos and gadgets and gears isn't that much. It certainly isn't $1,500. And so, but the market says, "Oh my gosh, this thing is a whiz bang. I have to have it. Yeah, I'll pay $1,500 for that phone." So they are a price maker. Commodity companies, oil, gas, mining, are price takers. The world sets the price, and you have to fit your company to that price. That means that based on supply and demand, you could be profitable one day and in the red the next. It's a very difficult business. It's why they're so cyclical, and it's why, we I tell people all the time, never ever be a buy and holder of mining companies. They are subject to all sorts of external forces. But when they have a tailwind, like we do right now, particularly in gold, they make fantastic investments. So let's look at Newmont for just as an example, because Newmont is the starkest example right now, and I know lots of people in the industry that hate Newmont because they know it so well. But here's what I'm going to tell you: Newmont at the end of 2023 posted a free cash flow number of $97 million. That's, I mean, it's free cash flow. It's not negative. It's okay. And with companies like this, we often, when we're doing analysis and you break everything down, you go straight to the free cash flow line and you say, I'm going to pay some multiple of the free cash flow, because that way, if the free cash is negative, we don't even look at it, right? If they're losing money, which is if you have negative free cash flow, you're either you're basically spending more than you have, so you're taking on debt, right? So we go back and look at the free cash flow numbers. Newmont had 97 million at the end of 2023 in free cash flow. The trailing 12-month free cash flow number right now for Newmont is $4.2 billion dollars. Now, if we let's say we just put, just to make the numbers easy, if we were if we were looking at these guys on some fixed value multiple of free cash flow, to go from 97 million to 4.2 billion, that's a significant increase in it should be a significant increase in the share price, because the multiple, the valuation says this company is worth a whole lot more money. But here's the thing: at the end of 23, the share price was about $40, and today the share price is about $58. So, we saw roughly a 50 less than 50% increase in the price of the company, and we saw the free cash flow multiple go up, 40 times. So that's pretty significant difference, right? So you have this company that is stacking cash in the bank right now, and its share price is kind of like, all right, we'll give you 50%. And I think what that says to me is that, like you, the market is skeptical of gold miners. They're skeptical that this is going to last. And to me, what that says is this is a screaming opportunity. This is a flashing light of buy these stocks, right? And again, because this is the commodity tailwind, I want to buy multiple producers, right? I want to buy a basket of these stocks to take get as much of the benefit as I can, because historically Newmont hasn't been the best steward of capital, but they're going to have a lot of capital to squander here real soon. So they're going to make this will move into the broader gold mining space. It's going to be a net benefit to all the companies as these guys go to replace their existing mines. They find mines that they want to buy. They invest money. They make new discoveries. To me, this is just a fantastic signal that the best is yet to come for the miners.
See, I think that is kind of a crucial path here because it really depends how you want to value these gold companies. Are they growth stocks or are they value stocks? Because I look at PE ratios, right? And the average PE ratio, trailing 12-month PE ratio for the S&P 500 growth stocks is between 28 to 35. For value stocks, it's 12 to 16. What we're seeing in some of these major miners is they're very much priced like value stocks. But argument being, they're not growing production. The underlying metals price and being a price taker, that's
Right.
helping them grow right now. As you're saying, we need to see them start to spend some money, start to actually grow their production, I think. And that can bring in a wide range of different type of investors. But yeah, Newmont right now, their trailing PE ratio is 13. Their forward PE ratio is only 14. But you look
Right.
at Agnico, they're 26. But Agnico is arguably a better miner right now with higher margins. Then you look at the royalty companies, Wheaton Precious Metals, that's a 67 PE ratio. Forward or price to forward cash flow ratio of what is it, 45. So look,
Yeah.
some of these, it's just a wide skew of how they're getting valued. But I think the biggest concept here is, are these growth stocks or are these value stocks? And right now, they're continuing to fall into the value stock sector because they're not out there spending this money. I think they need to be. And that brings in, again, more investors.
Yeah. The problem with these trailing PEs is this is like it works great if you're selling t-shirts and the price of the t-shirt really doesn't vary that much. But in the last 12 months, the price of gold has gone up 45%. So the value of the company today, all things being equal, right? So yes, costs are going to come up a little bit, but you're making 45% more for the same ounce of gold that you produced a year ago. The company today is worth significantly more. So when you look at a price, you're looking at today's price versus the end of the year's earnings. And I'm going to argue, yeah, I think that you need to look at forward, and I think the forwards are probably not they're not that great.
No, they aren't. In
So
all
in this,
fairness, forward PE ratios, yeah, for Newmont, 14, for
yeah,
Agnico, 20, even for Wheaton down to 40, Barrick's at 10. So fine, the
so
forward PE ratio. I get
back in the
that.
day, yeah, back in the day, what I would do is I would go back into their financials, look at how they calculated their earnings, because a lot of times you know, gold is only some part of the total earnings. And so, you build a spreadsheet and then you just change the gold number. But don't forget, with a company like Newmont, they're producing gold, silver, and copper. That's their general mix, right? We just talked about silver. It's at all, it's the highest price in more than a decade. Copper just set an all-time high. Gold's up 45% a year and it's at all-time highs. These companies are valuable. They're valuable today in a way that growth stocks aren't valuable today. It used to frustrate the crap out of me when people would look at the um, number of users of a platform like Amazon and say earnings today don't matter. They're going to monetize their consumer base, and that's why we're going to pay 110 times earnings for this company. And meanwhile, Exxon Mobil's trading under 10 times earnings for a company that is just has no debt, has massive volumes of cash, and everybody used their product every single day. So a lot of this, as we said, it comes down to sentiment rather than emotion, but sentiment is probably the right way to put it. And look, sentiment on mining companies is negative. The young people don't know about them. The people that are salivating about this stuff are the people that were in the market during that run from 2002 to 2012. And there are far fewer of them today than there were. And the new kids, the young people who've come up since then, are way more interested in cryptos because that's what people are getting rich in. Tech stocks, the Magnificent Seven. Um, so, money will come back to this sector. And as money comes back to the sector and it begins to perform, more money will come, new money will come. But the sector has to behave. And traditionally, that's where the mining companies have had difficulty. I mean, I don't want to shame any of the companies, but I think you and I can probably name 10 acquisitions off the top of our heads over the last 25 years that companies paid companies lost 80% or more of their initial investment in that acquisition. Hopefully, going forward, companies like Barrick and Newmont and Kinross and Agnico will do a better job of evaluating their acquisitions and not massively overpay again. But we'll have to wait and see.
Oh boy, will we ever. And again, hey, if the mining sector was valued like the tech sector, it would be a different world. But as of now, it is not. And one thing to consider, it's all about the cycles, right? Gold's up
Yeah,
3x in 10 years, but
yeah.
the last couple major cycles, it's been up 6 and 7x, like the 70s and the aughts, as you mentioned. So, hey, if it keeps going, then, well, it will get more value. Let's move over to ETFs then. The Global X Lithium ETF, LIT, LIT. We all know how much pressure lithium has been under, but this ETF, you brought it to my attention, just how strangely constructed it is. Take us through what you're seeing in this ETF that really promotes itself as investing in the full lithium cycle, from mining and refining the metal through battery production.
Yeah, I was just doing an essay on lithium, and I needed a good example of, lithium stocks. And so it's the ETF. Like if you wanted to invest in lithium, you bought this company or you bought this ETF. And so I went to the holdings and said, all right, what do they own? And the two largest assets are what you would expect. The two big lithium producers, Albemarle and SQM, the big Chilean or Peruvian, I forget what country they're from, but it's a big producer. But then I think the next largest holding is like Tesla, which made no sense to me whatsoever. Because if you think about producers and consumers, the price is a seesaw. So you have producers on one side of the seesaw and consumers on the other. And when the price goes up, the value of the producers goes up and the value of the consumers goes down because the producers get more money for the metal, but it costs more to the consumers to use that metal. And then vice versa. When the price goes down, the producers go down because they're making less money, and the value of the consumers should go up because their input costs go down, therefore they should be able to grow their profit margins. So the idea that you have all of them in the same basket where they're fighting one another, so at any given time, some of them are going down and some of them are going up, just made no sense to me whatsoever. Right? It's like being long and short the same stock at the same time. Like that that's not you don't want to do that with commodity stocks. I understand wanting to play it safe, but this is not the space. You don't invest in commodities to be safe. You invest in commodities for the leverage because when they run, they really, really run. And we saw that with lithium prices. And when they turn around and head south, man, it's even worse. And lithium has been just a great example of a commodity that, I think it's down 86%, 88% in just a couple of years. Like that's devastating to mining companies. Devastating. Like you can't cut the price, you can't cut the value of the commodity 80 some odd percent and expect them to survive. Right now, a ton of lithium is right around the break even of the big like SQM. That's right where we're at. So these guys are barely break even right now. And that's this because of the style of lithium that they produce. It's they pump the brines out and let it evaporate in the sun. But what this is going to do is absolutely demolish all the hard rock lithium development projects that are out there. These guys, there's no way that they can be economic. There's no way that they can get the loans they need to build their mines. this is just going to destroy this. And the bottom half of the of lit holdings are all these juniors, these junior producers. So you have the car makers, the battery makers, the producers, the developers, all in one big unhappy basket, and it just doesn't make any sense to me whatsoever.
Well, especially the miners, they're struggling so much, as you said. The prices at cost of production, which we have seen in almost every other commodity during certain cycles, and that's where it's very tough to be a miner. But to your point there about, I guess, the future outlook here and what these lower prices do, just wait until somebody figures out DLE technology, or if
Oh,
somebody
yeah,
figures that out,
absolutely.
because that turns this whole sector on its head. But again, to lithium ETF, it begs the question, do we need a lithium ETF? Do people, if people really want to invest that much in the lithium price, this doesn't even follow the lithium price. So it kind of follows, yeah, the life cycle of lithium, which, hey, the ETFs held up better than the underlying commodity, but we're in a world of ETFs. People do want to invest in ETFs. And even as you're saying, build a basket. The problem is everyone looks at these ETFs and says, they're a crappy basket. Why are they building it this way? So, what's the solution then, Matt? Because the world wants ETFs and passive investing, but everyone complains about the ETFs.
Yeah, I think you need to figure out how to build a good one. The it takes a little bit of effort to build a good ETF. Some of these things, like I think Lit is a great example. They were just playing off lithium, and there just aren't that many good aren't that many that you can build a fund like this around that can handle the volumes, right? So they were kind of stuck. They were getting pressure from marketing. Marketing said we have to have a lithium product. We have to have a lithium product, and you know the people who understood the market were going, well, there are basically two investable companies in lithium, and it's Albemarle and SQM. And they're like, no, we can't have it just those two. Find us other things. And they're like, well, Tesla uses lithium batteries, and the marketing group went, great, put them in there. Financially, it makes no sense whatsoever, right? But if you're just going out to sell a product, which is what this company, what this ETF was. It wasn't about making you the investor any more money. It was about getting you the investor to buy this thing so that they could collect the fees. That's what this was about. And from a marketing point of view, Lit was stupendously successful. When you look at the volumes, like we talked about this off Mike earlier. I mean, these guys, this was the massive ETF in the sector, massive. And so they collected a ton of fees, which means that they didn't learn any lessons, which means that going forward as investors, we're going to have to take a much closer look at what our ETFs are holding, who's managing it, and how it will respond to commodity prices. Because if I want long lithium companies, I don't want lit. And if I want short lithium, if I want to buy the consumers of lithium, I don't want lit either. So I want to buy these things on my own. But like you said, the sector got popular quickly and in a way that made investment very, very difficult. And so this was a way to attract money that wanted to invest in the space without really offering them any upside from an investment point of view.
Yeah, just look at those price moves starting in 2020, the COVID low down at $17 and change, and in under 2 years it was up at $94 and change, and now the whole way down into the mid 30s. So it's been volatile. It was a good investment for some people, clearly, if they caught the bottom or any type of that upswing. But hey, these ETFs, it's just the market that we are in. People want
Sure.
ETFs, and now they want low fee ETFs. Rightfully so, because the world has shown us, especially if you just buy something like an S&P ETF or an indexed ETF, you've done pretty well. But I feel like commodity sector, it's different. It's not buy and hold. It's not a bunch of growth companies and a bunch of minerals that have these outlooks that they just keep on growing in demand and price keeps going up. So I personally just don't know how well ETFs fit in the commodity sector. other than simply for traders, but that's more what we're getting at. Over and over
Yeah.
again, it seems like you need to be an active trader in the commodities sector, which actually ties into the oil topic that we have here with the Iran conflict that has helped to drive oil prices. Oil crude entered the month of June $63. It was down at $56 in April and May. As we're recording this, it's now around $75 a barrel. That's a huge move, and I think we can say a lot due to that Iran conflict, but
Oh, it's all due to the conflict. It's
but
all
then
due.
how much is that going to stick around? Is this just
It's
another
not.
one of those trades?
Yep, it's a trade. I wrote a piece about this for my Substack. This is not like here's the historic comparison is the first Gulf War when Iraq invaded Kuwait. The price of oil jumped massively, and within a year it was back down to where it had been before. The math, the headwinds of demand and supply on the price are huge. If this hadn't happened, if Israel hadn't struck Iran, then I think we would have been under $60 a barrel by now. This is a this is a short-lived. As soon as in the back in the 90s during the first Gulf War, as soon as the U.S. and the coalition got involved, the price of oil began to collapse. So this is a trade. Don't think that this is going to drive oil prices up to $100 a barrel again and stay there. It's not. It's just that this just isn't that sort of thing. The supply of oil globally doesn't reside in the Middle East the way it did in the 90s. The US is still the world's largest producer of oil, and demand's just not there. So you have all the OPEC nations have opened their spigots. The worst thing that could come from this, if you're looking for reasons why crude might go higher, the Straits of Hormuz are still the choke point for the world's oil transportation. And if Iran is threatened enough, they could absolutely close the straits. And if they do that, we'll see a temporary hike of oil prices, probably up another 10, $15 a barrel. But again, it's going to be short-lived. So, like, don't go loading up on ExxonMobil because you think this is going to be around for a while. It is not. This is one of those where, I'd be shorting oil here anytime. So,
See, the question is, does oil go into a state of acquiescence here where it doesn't really move and the companies start to struggle and they're not making the same amount of money, especially for US producers? If that price gets into the mid 50s or even drops below 50, then they're not cash flowing,
no,
really
no,
anything. And then they're not
no,
returning money to shareholders,
nope.
which these companies are great at returning money to shareholders. They issue dividends, special dividends. They buy back shares. They really don't keep much cash on the balance sheet because they churn through this cash. But you look at the chart of crude over the last 4 years after that spike in 2022, I guess 3 years from there, it's been consistently lower highs. It has been fading lower. But I remember it wasn't that long ago that the oil sector was dead. All the juniors were practically out of business. The major companies, they were still doing okay, but they weren't turning off this churning out this kind of cash flow. And investors turned away from them again, also because it's a commodity sector, just not a growth sector. Then, do you think that oil could go back into almost the doldrums that it was in a while ago, where just no one cares and these companies aren't making great money?
Yeah, I did. I absolutely. I think we were on our way. So if you go back and look at the rig count, which is they Baker Hughes tracks the number of drilling rigs in operation by various by commodity and by location. And one of the things that we saw was the rig count had plunged, and that is an indication that oil companies are cutting back expenses. And they were cutting back expenses because a break even in the patch today is about $60 a barrel. So the Permian Basin, they weren't drilling a lot of new wells. They weren't. They just that meant a lot of, they weren't bringing on a lot of new oil, they weren't bringing on a lot of new gas, and that's because in that last 2015, 16 period, I can't remember exactly when that was. The last time that OPEC came out and said, we're not defending the oil price, and the oil price collapsed. I think that was 2016. It had been plugging along for years above $80 a barrel, just absolutely killing it. And the U.S. shale production was just going great guns, and the OPEC nations were cutting. Yeah, so that started in 2014. We flooded the world with shale oil, and so we went from $100 a barrel down to about $50 a barrel. And then OPEC said, you know what? We're not going to cut supply. We're actually going to increase production, increase supply, because we're going to fight the U.S. creeping into our market share. That took oil down under $30 a barrel. And that had systemic, fundamental impacts on the entire U.S. oil industry. So at the time, I went down to Abilene, Texas, because a good friend of mine and mentor in the oil and gas industry lives down there. And we went out to lunch with a couple of bankers. And they they were involved in lending credit to oil companies. And so back in the day, what they used to do was, because oil and gas is a very capital intensive business, it's $1 million, $2 million to drill a well. The the banks would lend you the money to drill wells, and you would secure the loans based on your production. And these guys were fat and happy, these bankers. So we go out to lunch with them. They're like, "Oh man, all of our loans are secured at $40 a barrel because oil prices will never go back down to $40 a barrel." Well, those guys aren't in the lending to oil business anymore because the oil prices went well below $40 a barrel, and it killed all the credit revolvers. And that was common knowledge. So it wasn't like OPEC didn't know the number that they needed to get the oil price down to. And so it was financial warfare. I firmly believe that we were headed that way again. That there was the OPEC countries said we are going to open the spigots. We're going to claw back market share because the it took a decade for the oil industry, the U.S. oil industry, to work its way back because they had to build up from where you were talking about. They were no longer able to get easy loans and credit revolvers, so they had to drill off of their own free cash flows. And so it wiped out a lot of private equity, it wiped out a lot of capital, and you had to build those cash reserves back up and then put that money back to work. And we're much more sensitive in the oil patch today to commodity price fluctuations than we were prior to 2016. And so, yeah, I'm very confident that oil prices were headed back below 60 and maybe back below $50 a barrel because that was the pain point. That's what puts U.S. shale producers out of business. And OPEC is ready to claw back some market share. So,
Yeah, that's so true. We'll end it there because they've even said they want more market share and they see, I guess, an opportunity to take back some from the U.S. And right now, quite frankly, people aren't looking very favorably at the U.S. So just another arrow heading
oh,
towards the
that
U.S.
stings.
But that's a whole other topic, isn't it, Matt? Hey,
Yes, it is.
everyone. Thanks for tuning in to this week's Resource Rundown. I'm your host, Corey Fleck, along with Matt Battiali. Check out Matt's Substack. We will link to it in the show notes. And check out all the market interviews that I do over at the KE Report. Please keep in touch with Matt and I through email. Let us know what topics or news stories you would like to hear on future Resource Rundown podcasts. Everyone, thanks for tuning in. We'll be with you next week. This episode has been produced by the Clear Commodity Network, your source for commodity news and commentary from the top of the food chain down to the juniors. Be sure to check out my daily podcast, The KE Report. Be sure to subscribe and share this podcast with your friends. Also, send Matt and I any articles or stories you would like to hear us discuss on our future episodes. The next episode coming at you in 2 weeks' time.